Let's welcome in our next guest, Taher Badshah, Head Equities MF at Motilal Oswal AMC. Taher, you have a lot of focus as far as mid-caps are concerned, and for the last 2-3 years, some of your funds have done very, very well. Now, do you think mid-cap being at a record high, expectations are very high for the mid-cap space, and they will really have to deliver in Q1 or probably the next 1 year or so to meet these prices or match up with these prices?
So yeah, mid-caps is a very vast area, and therefore there will always be areas where there will always be pockets where there will be a lot of mispricing both ways, and that is exactly what is the situation right now as well. So there are certain stocks and certain sectors which probably look a little stretched out in the near term and probably look like they have done significantly ahead of what the market probably expects in the near term and maybe out of the next quarter earnings. But then there are always different sets of ideas which are growing at different kinds of different rates of growth, and to that extent it's difficult to paint a one-stroke picture as far as mid-caps go. Although from a basket perspective and maybe from an index perspective, perhaps the divergence between the large cap and the mid-cap seems to suggest that we are probably a little more stretched out as far as the mid-caps go compared to the large caps, but there would still be individual pockets where you would probably continue to find better opportunities of growth even in the mid-cap space.
Right. As far as the large cap space is concerned, at Nifty 8400, we are definitely not cheap. There is a certain element of the certain half of the Nifty which is probably likely to show earnings surprises, and maybe that is what will probably suggest that the overall apparent valuations are probably not as expensive as what they appear to be. So you will see quite a lot of rotation out of cyclicals and PSU banks, which at the margin might probably be earnings accretive when measured from the standpoint of the Nifty, and therefore to that extent what is visible is may not necessarily be the case. However, even on a consolidated basis, taking into account some of the expectations regarding recovery of earnings in cyclicals and banks and industrials, etc., we are kind of trending well. We had about 17 odd times as far as 1 year forward earnings go, with an expectation which is a little more moderate now compared to what it was earlier. We are now expecting earnings growth of more like 15 odd % for this year. Across most swaths of the street. Most times we've had situations when we enter into the year with expectations of 20% plus earnings growth. So this time around, I think we are a little more modest in that regard. And if we were to
Mr. Badshah, if one takes Nifty earnings, let's say 475, anywhere between 470 to 480 rupees, that's being estimated. Currently, as you said, that 17, today it's trading at approximately 17.5 to 18 times FY17 earnings. Now, if I look at Nifty actual earnings of FY16, the change that you're expecting is close to what, 22%, depending on which range you are. Is that, given the current strike rate, what you've heard, and whatever the economy is looking at, do you think that we'll hit that 476 rupees for FY17?
Well, our numbers suggested that we are looking at from a Sensex perspective, Sensex earnings perspective, it was a growth of around 15-16% for this year, FY17, and I think that's something which is still relatively more achievable. So the wall to climb is relatively more easier compared to what it has been in the past. Plus, we should not forget that some of the benefits that we are likely to see in this current year will probably influence the earnings of FY18 as well in a more meaningful manner. And if we were to probably see a good monsoon, as we are now kind of starting to build in and we are observing as well, I think not just second half of this year, but perhaps you will see stronger growth in the rural segment of the market even into the next fiscal year, and even led by...
What is your Sensex earning estimate, sir? Is it would it be around 1900 rupees? What are you expecting it to be?
I think it is more in the vicinity of around for FY18 it is in the vicinity of around 1800.
FY17 is 1800.
FY18.
FY18 is 1800. All right, that means it's currently trading at quite high multiple compared to its history.
Yeah, not really. I mean, we are talking about I would assume that as far as I remember the numbers right, I think we are trading at about 17, 18 times FY17. We're looking at about a 20% plus growth in FY18 on Sensex.
Okay, all right, that's the Sensex number. Just give us a sense of where you think the banks are placed. A lot of banks have run up dramatically, and I mean, people come and give warnings and say that they have now gone out of that space where they were supremely cheap. But they're still running up. Today, again, we're seeing a lot of banks, PSU banks especially, are doing well. What is your view on that?
No, I don't really think we are very expensive on valuations as far as the PSU banks go. Although we have a different set of challenges out there, but valuations on more of core operating earnings or adjusted for the large NPA provisions that have happened in the last year. They are not as expensive. I mean, even an SBI probably trades a little over 1 time price to book. Consolidated for all its subsidiaries. So, and many others are well below 1, and some even a good part of the PSU bank spectrum is somewhere around half time price to book or 0.6 times price to book. So that set is not as expensive. What you're probably referring to is clearly the private sector banks, where we have seen continuing performance of the stocks as well as reasonably high valuation. So one can argue that there is a little bit of an overpricing which is there in the shorter to medium term, but they have a lot in terms to go as far as growth and visibility goes.
Right. What do you make of the NBFC sector and the re-rating over there? Do you think that NBFC sector, MFI as well, together put, has re-rated quite a bit after the Q4 numbers?
Yeah, there has been a fairly strong performance of the NBFC sector across different segments, be it consumer finance, be it home finance, or perhaps even now maybe some of the other assets like gold finance companies and so on. So we've seen a fairly decent performance out of these companies. But for the more foreseeable future, the next 1 or 2 quarters, the growth is looking more like being in the vicinity of between 25 and 50% in some of these names, especially the mid-sized NBFC companies. Even some of the larger consumer finance companies, etc., housing finance companies are looking to grow at a fairly high clip compared to the rest of the market rate of growth. So therefore, the excitement around these names will probably continue. They are also reasonably large beneficiaries of cost of funds actually coming down, and the size of the opportunity from a more longer macro perspective remains reasonably strong for many of these. So no reason to immediately expect that they will correct significantly, but you could always see some bit of a give off post their strong run up if we were to expect expectations to have been built a little further away from what finally they deliver.
Right. As far as something like a SKS Microfinance is concerned, we're getting 2 views coming in. So we've got a Morgan Stanley upgrade coming in today. A few days back, we got Credit Suisse downgrade coming in saying that, valuations are very high. Do you think right now they are in a situation where you would just wait for a couple of results before, taking a big bet on the MFI space?
So again, this is one part which has performed exceedingly well in the last some time, and underlying growth again are more in the vicinity of around 50-60%. Last quarter, in fact, in a couple of these names, the growth was even in the vicinity, even as much as 100% growth. So the sector continues to be on a binge, and if we have to probably see a recovery in rural demand and rural prosperity, I think this segment will probably continue to remain reasonably high in terms of growth rate. But yes, there is a certain amount of overextension which has happened in as far as multiples go, even in this particular subsegment of NBFCs.
How would you go ahead and look at something like the news flow coming in on pharma? So last week we had 3 EIR reports coming in, one for a big company like Lupin, then for a mid-cap company like Cadila, and then for a slightly smaller company like Alembic. So do you think the concerns are coming down as far as FDA-related issues for the pharma sector is concerned? Plus, these stocks have underperformed quite a bit. So, maybe there is some value over there.
Yeah, that's precisely what is happening in the market. This is a segment which has been, this is a sector which has been beaten down, and largely for one particular reason, which is regulatory, which in a way affects business prospects pretty significantly one way or the other. And therefore, it is nice to see that we are seeing some bit of reversal in terms of the US FDA activity. We would believe that that is the recent indications out of some of the companies and some of the clearances which have been obtained do suggest that we could see a faster pace of approval of some of the companies for which the issue has been pending for a very long period of time. And that could clearly reverse sentiment for this sector in the near term. As you rightly said, these are also beaten down. They've underperformed. Long-term growth is not necessarily as hazy or cloudy, and therefore if we do get these approvals, then it clearly improves the picture for second half of FY17 or 18 or FY18 in terms of the earnings capability.
As far as any of these EIRs are concerned, do you think that the growth would only return in FY18 because the approvals have to come, then they have to launch, and as of now you don't get any signs of these approvals coming in?
It's different with different companies. So there are some who may be able to take advantage of clearances if they are obtained right now, even in the second half, or let's say up to the fourth quarter of this fiscal year. But for many, and when most of them, I think the scenario will look substantially better for FY18. And in some cases, maybe the market would want to price them on FY18 earnings as well.
Right. Most of the people or most of the fund managers that we are talking to are, going ahead and taking big exposure on the infrastructure space. I was just looking at your portfolio holdings. So, you have CRISIL, you have Max Financial. I'm talking about Motilal Oswal 30, WAPCO India, Amara Raja Battery. Not much in terms of infrastructure or any big infra recovery. Are you not looking towards that, or you are right now in the process to go overweight on any sector?
So this portfolio has not really been built on the basis of cyclicals or non-cyclicals. They've just been built on the basis of bottom-up ideas which look meaningful to us from a more medium to longer-term perspective, and where we see capabilities within those companies to stand out even in a tough environment. So I think we have, if we were to probably classify them on the basis of industrials or cyclical, this thing, we have a relatively lesser exposure. You're right. But then there are quite a number of them which are linked indirectly or directly to an industrial recovery. Say, for example, a CRISIL for that matter, or maybe even a WAPCO which continues on a cyclical recovery of commercial vehicles, which is again linked to the economy. We have a few companies in the industrial space as well, such as Timken, etc., which probably are also linked to things like railways, exports, domestic cyclical recovery, and so on. So we have a few pockets of exposure in that area as well.
Right, but overall, as far as most of these names are concerned, these are names which are very high PE or valuations are very, very high. Any particular reason, or you look at very high growth companies and then try to buy them, or some of these when you would have bought, the PE would have been quite low?
Yeah, some of them have kind of done very well for us in the recent past, and maybe they have kind of expanded in terms of multiples more recently. But I think focus has also been on ensuring better quality names, and these are companies which are relatively strong in their respective areas. Their balance sheets are squeaky clean, and they also enjoy a very niche positioning in whatever they do. So to that extent, given that they have large market shares in their respective areas, and they are almost leaders or number 2 players, number 1, number 2, number 3 players in their respective categories, they enjoy that additional premium in the market, and to that extent they don't come as cheap. But clearly, we have tried to keep a far more larger premium on quality of companies than just cyclical recovery or shorter term earnings momentum.
Right. As far as the overall growth that is concerned, or growth that is likely to come in, again, if I just look at the portfolio, it's housing finance, it's Havells, which has done very well, Ajanta Pharma, which has done very well. So do you think the companies which are growing will essentially tend to grow further as we see a pickup? That's the basis that you're looking at, or you would be looking at some of the PSU banks, probably something like a JP Associate, which is likely to see a recovery coming in because of the corporate action that they are taking place. How would you essentially look at growth coming in going ahead?
No, so we are not clearly looking at companies where there is shorter term action or it is governed by certain corporate actions in the near term. That is clearly out of question. We are only looking at stability of earnings, not just from the point of view of the long term, but even in the medium term. And to that extent, many of these companies have grown well in the past, and we see there are individual triggers in different in all the companies that we have. There's no one particular driver of these different names. So they are all varied, as you can see, and even in the NBFC space, for example, we have got companies which are as diverse as consumer finance to ratings to housing finance and so on, and they're all places which don't have anything to do with each other in a way. So it's all based on individual growth drivers for each of these companies. We are looking for companies which are solidly positioned in their respective areas, plus they have a decent amount of growth in front of them, and that they have and the ones that they have delivered in the past as well on a consistent basis. So I think this forms a core. At some we have looked at companies which on the margin are kind of emerging from the shadows and maybe are have the characteristics that we desire and are looking forward to better growth than what they have enjoyed in the past. But it is important that they have the basic capabilities, they have some interesting niche that they operate in, and certain leadership characteristics.
Right. Just a word on the metals and the PSU banking space. If you would have looked at from the Feb lows, which was probably the low of the market during the budget day, we would have seen that metals pack, even the large cap ones, names like Tata Steel, names like Hindalco doing very, very well. In the PSU banks, names like SPI, BOB, the large caps and the small cap ones have done very well. Are you looking at these sectors? They are large sectors, they are very well-tracked companies, and they have done phenomenally well. Would you look at some of these sectors which essentially people have not owned for the last 4-5 years as a contra bet?
No, so we have not been present in let's say the very pure cyclical space, particularly the commodities space. But we believe that there are certain indirect beneficiaries. Again, like for example, there could be some PSU banks which probably benefit out of this improvement in fundamentals for some of these stress sectors. And if we are seeing that as an option for some of these banks, and where we are reasonably comfortable with the situation on NPAs, etc., for example, and SBI, which is a part of our portfolio, that is a way we have kind of been participating. So we have not looked at some of the very pure cyclical names which are only dependent on global factors, and where ability to assess longer term earnings is always a difficult proposition.
Right, Taher, thank you so much for joining us here this morning. Hope to see you again.